Good evening, everyone. So here we are on day 33 and we'll start today in Ind AS 19, a very important standard again from both examination, real life, and also from the complexity angle. It is a slightly complex standard. I keep on telling I was scared of this standard, and I hope after these sessions you would no longer be scared of this particular standard. So we're talking about Ind AS 19. I hope my audio video is clear. If it is clear, you can just say yes, it's clear as a confirmation, and then we can proceed further. Okay, so it's clear. Yeah, it's clear. So today we'll start with thank Rajeshri, thank Akshay for the confirmation. Today we start with Ind AS 19 that deals with employee benefits. Now this is one standard which would cover almost all aspects of accounting for employee benefits. It may be salary, may be bonus, it could be any other aspect. All of that would be covered under Ind AS 19, right? Now, when we say employee benefits, please remember there is an employee and there is an employer, right? Now, this employee works for the employer and this employer in return pays something. What does it pay? It can pay salary, maybe basic salary, or it could be bonus, or it could be something like contribution to PF, right? You would have learned in taxation also. Every year we contribute some amount, every month we contribute 12% of basic plus DA if applicable to PF. So PF can be one thing, or there could be something called as gratuity. After you work for, let us say, 5 years, you are entitled to some gratuity amount, correct? So like this, there could be multiple components of employee benefits, and sometimes it could also be like paid leaves. Paid leaves is like the employee will get leave without working and he will get paid also. For example, if I am working in an organization, the organization says every year you will get 24 paid leaves. Now 24 paid leaves means what? For 24 days you don't need to come to office. Even if you don't come to office, we will pay you salary for 24 days, or we will allow you to carry forward to the next period. So this is also one form of employee benefit, right? So all of these components, what are employee benefits, what employer pays to the employee in the course of employment, is called employee benefit. Now what does Ind AS 19 tell us? See, something like salary, bonus, contribution to PF, these are more straightforward, but challenge comes when we say, let us say, gratuity payable. Now gratuity, the way it works is, if you once you become chartered accountants in the future, and if you choose to work for a company, or you hire employees, whatever way it is, let us say you qualify and you become a chartered accountant and you join a company in 2024. What the company says is, you work with me for 5 years. You work with me for 5 years. Now what is this 5 years logic? Basically they are seeking loyalty from you. Okay, we are not, and please remember, CA is one of the very few professions where bonds are not required. If you ask any engineering placement or any IT placement, they will say execute a bond. Here as CAs we have that privilege. I have not seen, very rare cases there could be a bond requirement, but otherwise there is no bond requirement. So you join in 2024. What the company says is, it gives you a lollipop. What is that lollipop? You work for 5 years till 2029. Then for every year I will give you half month salary, or 15 by 26, whatever is the calculation, for 5 years based on your last run, let us say, basic salary. Now this is what is called gratuity. Okay, when will this be paid? This will be paid in 2029. But why am I paying this in 2029? I am paying this in 2029 because I have worked in the organization for all of these years. You have worked in the organization for 5 years, because of which gratuity is being paid. Now we all know the concept of matching concept. Because I have worked for 5 years, this expense also, whatever is payable here, should be accounted for these 5 years. How to account for that? Who does the accounting for it? How do we calculate? All of that we will understand as a part of employee benefits. Another aspect is leaves. For leaves also, let us say the company says you will get 24 PL, means you will get 24 paid leaves. Sir, what if we take the leaves in the next year? But I'll suggest one thing personally. You should take leaves as and when it is appropriate. Don't think that I'll accumulate the leaves and I'll encash the leaves at the end of the service period. You will actually not enjoy lifetime, right? So leaves you can take next year. Now what are we saying? These 24 leaves you are entitled to in the current year. You can take these leaves in the next year. Means next year 24 days don't work. Next year 24 days don't work. We will still pay you. So the employer is saying I have an obligation to pay you even if you don't work, or I may give an option, something called as encashment. You are a very loyal employee, and as per the organization policy, we will say, okay, you can encash the leave. So either you can take it next year or you can encash next year. How do we account for this? That is also covered as a part of Ind AS 19. Then there are some straightforward aspects like short-term benefits, contribution to PF, where we can easily account for it. That is not much complicated. Major focus will be on these type of scenarios where we will understand how do we do the accounting for it. So that is the broad background context for starting this standard. Now employee benefits, just give me a moment. I'll also pull out the notes so that now one thing, if you want to share or want to ask, what are the areas which you find challenging in Ind AS 19? If you can share it with me, I will also try to address them as we move further. Sorry. Okay. As and when you have questions, you can definitely ask, not a problem. Okay. Now, the employee benefits that we are talking in this standard are those which are provided under formal plans or other formal agreements between an entity and individual employees, group of employees, or their representatives. Basically, what it means, there is an employer, there is an employee, or there are a group of employees. You would have heard about this term called unions, right? Now, they have agreed. There is either a plan or there is an agreement. Plan means the company has a plan. The company says, for every employee, I will give 2 days of leave per month. That is a plan. Or agreement. Your basic salary will be so much, your DNS allowance will be so much, your bonus will be so much. So either plan or agreement between an employer and an employee, that is an entity, and individual employees, group, or their representatives. So this is one where we say it is employee benefit. Then under legislative requirements, now this is a classic example is PF. You are required to contribute to the provident fund. So under legislative requirements, or by those informal practices that give rise to a constructive obligation. Informal practices means what? Informal basically means it is not written anywhere. There is no agreement for that, and there is no obligation on the employer as per the terms of the employment, but employer on its own as a customary practice gives some kind of benefit. For example, simple example could be every 5 years of completed service, we will give you 5 grams of gold. Or once you complete 10 years of service, we will give you 10 grams of gold. This is an age-old practice. This is an age-old practice, and because of this age-old practice, you have a constructive obligation. It is not legal. Constructive means something like you are telling that, okay, in the past I have given, in the future also I will give, but I am not committing. But there is still an expectation from the employee that if I work in this organization for 5 years or 10 years or 15 years, I will get some kind of benefit, right? So that is also covered under employee benefit. Now what it does not cover is reporting by employee benefit plans. Now what does that mean? There could be an employer, there are employees, and let us say there is a regional provident fund or provident fund authority. Okay. Now, employer contributes 12% of salary. Employees also contribute 12% of salary to this provident fund. What we will understand as a part of Ind AS 19 is how will the employer account, not how will this provident fund or the trust will account for it. So, our understanding here will be limited to the reporting by the employer and not by the provident fund plans or pension fund plans. Now, when we talk about employee benefit includes short-term benefit, post-employment benefit, other long-term benefit, this is employment, and termination benefit. Now, what is short-term benefit? Short-term benefit, a simple example could be your monthly salary, something which will be settled wholly before 12 months. So, salary you pay on a monthly basis, bonus you may pay on a quarterly or half-yearly basis. Whatever is settled within the next 12 months, wholly means fully, not even a part of it should be outstanding, then it is called short-term benefit. What is post-employment benefit? This is post-employment. Post-employment is something which is payable after the completion of employment. For example, gratuity. Gratuity will not be paid during employment, it will be paid post-employment. Then other long-term benefits. Now these other long-term benefits are anything other than short-term benefits, post-employment benefit and termination benefit. This is the residual category. So something which is more than 1 year maybe, that comes under other long-term benefit. The way we account for it will be most likely like post-employment benefits and termination benefit. Now this termination benefit is something like if I ask the employee to leave or if I terminate the employee's services, right? In that case, whatever I provide as compensation is called termination benefit. So short-term benefit, very simple to understand, we'll come to it. Then we have post-employment benefit. This is the most important aspect that you need to understand as a part of Ind AS 19. Now, employee benefits you can provide to employees, their dependents like a lot of companies provide medical insurance that is provided to dependents or their beneficiaries. And so you can settle. Settlement means when you have to pay. Okay, so it can be settled to employee, spouse, children, anybody else. And employee can be full-time, part-time, permanent, casual, temporary, anything. Just a broad understanding. Right. Now, the first part of it, very simple to understand, which is short-term employee benefits. Something which you pay, let us say salary, bonus, something which is settled before 12 months after the end of the annual reporting period only. It means fully it has to be settled. Okay. Then, what does it include? Salaries, wages, social security contribution, something like PF, it is short-term. It is short-term. Okay. Then, paid annual leave and paid sick leave. Now, what is this paid annual leave? You provide leaves to the employees saying that you take leave, we will still pay you. So, that is covered here. Then, profit sharing or any other non-monetary benefit. Right. Now, under short-term benefit, accounting is pretty simple and straightforward. For example, we pay salary. You will say debit employee benefit expense, credit cash or salary payable. No discounting, nothing is required. Very, very simple and straightforward. Now, the aspect where we have challenge or slight amount of computation required is short-term paid absences. Now, what is this paid absences? Let me give a simple example. A company may give something like, let us say, 12 paid leaves, 24 paid leaves. Okay. This is casual, does not accumulate. This part accumulates, meaning to say, if I don't take these casual leaves, this one, I will not get either money nor I can take it next year. These are called non-accumulated or non-accumulating. Paid leaves which accumulate, basically what it means is, if I don't take the leaves in the current period, I have the right to take the leaves in the next period, or I have the right to ask for payment if it is encashable. Okay, so those are called accumulating. So whenever we talk about employee leaves, you have non-accumulating paid absences, accumulating paid absences. So non-accumulating is something which you cannot accumulate and take in the future. This year leaves you have to take in this year only. You cannot say I'll carry forward and take in the subsequent period. Whatever is in the current period itself, you will take those leaves. So that is called non-accumulating paid absences. They do not carry forward. Right now, when they do not carry forward, there is no accounting treatment required. So why are you saying this? See, if I cannot carry forward the leaves, if I will not get cash in the future, means what? This is indirectly covered by my monthly salary. Whether or not the employee takes the leave, my salary amount is not going to change. What I pay to the employee does not change. So this is a short-term paid absence, and this is non-accumulating. No specific accounting treatment is needed in this case. Right now, the second one is accumulating paid absences. What is accumulating paid absences? If I do not take leave in the current period, I get an entitlement to take leave in the next period, or I can encash it subsequently. These are called accumulating paid absences. So these are the absences that are carried forward and can be used in the future periods if the employee is not able to use them in the current period. Right now, accumulating paid absences can be vesting and non-vesting. Now, what is the meaning of vesting and non-vesting? Vesting means you can get a cash payment. So if I am entitled to 24 leaves, I took only 10 leaves. These 14 leaves I can encash. Whereas non-vesting means you are not entitled to a cash payments for unused leave. Right? So whenever you are joining organizations, be careful in understanding what is vesting and what is non-vesting. Right? Now, whatever is this accumulating paid absences, what we will do is, end of the year, we will estimate the liability. Sir, how will we estimate the liability? We will see how many employees are likely to take leaves in the next year, or how many employees are likely to encash in the next year. There is an expert called an actuary. Okay, actuary, we will come to the actuary aspect. They will decide, or they will give us, okay, for any year, these many employees. For example, there are 100 employees. The actuary says 96% of them will take on an average 2 days of leave in the next period. So based on this, we make a liability provision or create a liability. So the entity shall measure the expected cost of accumulating compensated absences as the additional amount that the entity expects to pay as a result of unused entitlement. Now, whether it is vesting or non-vesting, whether you will encash or not encash, you have to estimate. Sir, why are we creating a liability when cash payment is not needed? The logic is, if in the next year, let us say there are 200 working days. For 200 working days, I am paying 1 lakh, just for example. Out of this 200 working days, an employee has a brought forward balance of, let us say, 20 days. Now, this 20 days is coming from the previous period, but still you have to pay 1 lakh. The employee worked 180, but you are still paying 1 lakh. Why are you paying 1 lakh? Because he did not take this leave in the previous period. He worked 20 days extra in the previous period, and hence, even though if it is non-vesting, we need to provide for the liability, right? So in the examination, only case where you do not provide is if it is non-accumulating. For accumulating, you will always provide for the leaves and the absences. Accumulating, right? Now, short-term paid absences, non-accumulating, accumulating, non-accumulating, nothing is to be done. Accumulating, vesting, non-vesting. For vesting, liability based on amount of cash expected to be provided. Liability based on expected cost of unused leaves. So you will provide these leaves and you will do the accounting for it accordingly. Okay. Any question in this short-term paid absences? Is it clear? Okay, thanks Kanishka, thanks Rajeshri for the confirmation. Let's look at a couple of questions on this. Mr. Niranjan is working for Infotech Limited. Consider the following particulars. Annual salary 30 lakhs. Number of working days during the year 300. Leave allowed 10 days. Leave taken. This is first year, this is second year. 7 days, 13 days. Leave unutilized carry forward to next year 3 days. Based on past experience, Infotech assumes that Mr. Niranjan will avail the unutilized leave of 3 days of year 1, year 2 in year 1 of first year in the second year. Infotech contends that it will record 30 lakhs as employee benefit expense in each of the year, stating that the leaves will in any case be utilized by the next year. Right now, here what has happened is he was supposed to take 10 days leave. He has taken only 7 days leave. Means he has worked 3 days extra in the first year, and he worked 3 days less in the second year. So very surely you should understand that the salary or the expense cannot be same in both the cases, because number of days that the employee has worked is not same in both the cases. Are you getting it? The number of days that the employee has worked is not same in both the cases, and because it is not same in both the cases, we cannot have the same amount of expense. That is the logic. And second thing is, an entity, whatever is the accumulating absences, whether it is vested or not vested, whatever is this closing balance, the expected cost of that we should provide for in the next period, or for the at the first year end as a expense in the first year, and a liability which will be settled in the second year. But sir, we are not settling this liability. But we have an obligation to give him 3 days of extra leave in the next year. For that, we have to calculate the amount. Sir, will there be any change if it is accumulated only for a specific period? Yes. So if it is accumulated only for, let us say, 2 years, a lot of companies have this policy that in the first year if you don't take, you have to take in the second year, otherwise it will lapse. So you will make an estimate of how many employees will take how many leaves in the second year. Is that clear? Now, how do we recognize the expense here? See, first you have to see what is the salary and working days. Salary is 30 lakhs, working days is 300 days. So 30 lakhs divided by 300, if you do, per day it comes out to 10,000. So the person is entitled to 10,000 per day. 10,000 per day. Right. Now, in the first year, for these 3 days, we have to provide him leave in the second year. So for 3 days, how much is the cost? 10,000 into 3, 30,000 is the cost. So what you will do is 30 lakhs plus 30,000 cost of the first year. In the second year, you will say 30 lakhs minus 30,000, which is 29 lakhs 70,000. So the way it will work is, see, 30 lakhs minus 30,000, which is the expected cost for the next year. So you will say no, sorry, I refer to the wrong table. 30 lakh 30,000 in the first year and 29 lakh 70,000 in the second year. Okay, this is the information, so ignore that. 29 70,000 in the second year. Now, how will we pass an entry? We will say, for the first year, you will say employee benefit, how much? 30 lakhs 30,000 to paid, whatever is paid, bank 30 to provision for leave encashment 0. This is 30. This is 30. Okay. Now in the second year, what will happen is this provision for leave encashment you will reverse. So in the second year, the expense is 2970. Provision for leave encashment 30. This amount is reversed here, and this 30 lakhs is what you have paid to bank account. Right. So that is how you will account for in the expense. Okay. Now the next one, the same illustration, slightly different. Niranjan will avail unutilized leave of 2 days in year 1 subsequently, of year 1 subsequently, means here we said 3 days. Here if you see 3 days, okay. Now in the next period we are saying that only he will utilize the leave for 2 days. Now if you utilize the leave only for 2 days, then what we will do? We will take 10,000 into 2, that is 20,000 as our closing expense. So 10,000 into 2. Now subsequently he utilized how many days? He utilized all 3 days of brought forward leave. Now this is a change in estimate. This is a change in estimate and we will account for it prospectively. We will account for it prospectively. Is that clear? Any question? Okay, no questions. Then next illustration. Sundaram Private Limited has a headcount of 100 employees in year 1. As per employee policy, employees are entitled to 30 casual leaves out of 10 casual leaves which may be carried forward to the next year. So you are entitled to 30. Out of 30, 20 will lapse in the current period itself. 10 will be taken forward to the next year. In fact, I worked in Bharat Petroleum and we had a very, huge list of holidays and leave entitlement. In fact, the entire Ind AS 19 video is available on YouTube, the entire 8 hour of content with detailed explanation. There I have, those of you who are interested to understand it in more depth, I have actually, explained to you using my own salary and computation as to how does it actually, work out in real life situations. Okay. So if you want, you can have a look at that. The full Ind AS 19 video is available on our channel itself. Right. Now 30 is there, out of which only 10 you can carry forward. So this is non-accumulating. This is accumulating. Only for the accumulating portion you will make a provision. 10 sick leaves, out of which 2 sick leaves may be carried forward. So 2 you can carry forward. Okay. On 31st March, average unused entitlement is 5 days per employee for casual leaves and 1 day per employee for sick leave. On an average, it is found that the number of such employees who would be claiming casual leaves would be 30 and 10 employees would claim sick leave. So you are carrying it forward. And what you are saying is, out of 30 days, you can carry forward 10 days. But out of these 10 days, unutilized leave is only 5 days. So unutilized leave is only 5 days. That is the average number. Okay. And how many employees are expected to use? 30 employees. So total is for 150 days salary. You will make a provision. Similarly, sick leave. Average unutilized means how much will be carried forward on an average. 1, number of employees 10, you will provide for 10 days salary. Now you may have a doubt. Sir, why will the employee not carry forward? See, everybody does not join on the same day. A lot of employee will resign. A lot of employee would have joined midway. So if you join midway, you will not get 30 leaves. Okay. So you will get proportionate leave. So based on that, these averages are calculated and the liability is created accordingly. Let's look at this one. An entity has 100 employees who are each entitled to 10 working days of paid sick leave for each year. So they are entitled to 10 days of sick leave. This is paid. Unused sick leave may be carried forward for 1 financial year. So you can take it forward for 1 financial year. Sick leave is taken first out of the current year's entitlement and then out of any balance brought forward from the previous period. So the employer is smart. First you utilize the current period entitlement, then you take it from the previous period. First you utilize the current period entitlement, then you take it from the previous period. Okay. On 31st March, average unused entitlement is 2 days per employee. So we have 100 employees. Of that we have 2. Based on the past experience, management expects that only 20% of the employee will use 1 day from their carried forward leave. So only 1 day they will use from the carry forward leave. Now calculate the expenses in respect of the short-term compensated absences if they are assumed to be vested short-term compensated absences, non-vested. Vested means what? You have to pay cash. Now if I am an employee and I have a leave entitlement, what will I do? Will I leave? If I don't take leave, what will I do? If it is vested, I will in cash. So if it is vested, Either I will use or I will encash. How many days? 2 days. So 100 employees into 2 days into salary per day 2500, you get 5 lakhs. Second case, it says non-vested short-term absences. Non-vested means what? I will not be able to encash. If I use, I will use. If not, it will lapse. Okay. So in the second case, how many employees are expected to use? 20%. So only 20 employees will use 1 day into 2500. In that case, it becomes 50,000 a day. Once again, here we are providing fully, because if the employee does not take, then the employee will encash. Any question? Okay, clear? Great. Then let's look at this illustration. Acer Limited has 350 employees, same as a year ago. The average staff attrition means the number of employees who leave, observed during the past 10 years represent 6% per annum. 6% per annum means what? If there are 100 employees, 6% will leave, we will be left with only 94 employees. Okay. Acer Limited provides for the following benefits to all its employees. Paid vacation 10 days per year regardless of date of hiring. So join in December, okay, you get 10 days per year. Compensation for paid vacation is 100% of employee salary, and unused vacation can be carried forward for 1 year. So you can carry forward for 1 year. As of 31st March of year 1, unused vacation carried forward was 3 days per employee. So you have 350 employees, 3 days per employees, and you have 94% retention rate, 6% attrition rate, right? Then average salary was rupees 15,000 per day, and accrued expense for unused vacation in year 1 was 65 lakhs. During year 1, year 2, employees took 9 days of vacation in average. Salary increase in year 1, year 2 was 10%. So in the next year they have taken 9 days of leave, and salary increase was in year 1, year 2 was 10%. And okay, we have not been told this number 350, same as year ago. So last year was 350, now also 350 employees. How would Acer Limited recognize liabilities and expenses for these benefits as on 31st March of year 2? Pass the journal entry to show the accounting treatment. So here, what are we required to do? We are required to focus on 31st March of year 2, where we have 350 employees. Right? Now, for these 350 employees, there are two categories. We are in year 1, year 2. Out of these 350 employees, whatever we have, there are some employees who have come from the previous period. There are some employees who have come from the previous period, and there are some employees who have joined fresh. How many have come from the previous period? 94% have come from the previous period, 6% have joined fresh. Now for these 94% employees who have come from the previous period, what do they have? They have carry forward 3 days. So they have opening balance 3 days. They can take leave. Okay. Then entitlement 10 days. Then they took 9 days of vacation. 9 days. So 3 plus 10, 13. 13 minus 9, they have entitlement of 4 days. Now here, unless it is mentioned in the question, we will always apply the FIFO method. That is, previous days or previous year's leave we will utilize first, and then out of the current year we will provide for the leaves. So 4 days of leaves is what will be provided. For how many employees? 94% into 350. So 350 into 94% are there from the previous year who have this balance of 4 days, into 4 days. If we do, we get that 350 into 94, 350 into 94%. Just to see. In percent into 4. So it is 1316 days and salary now has become from 15,000, it has increased by 10%. So 15,000 plus 10%, your salary is 15,000 plus 1500, 16,500. So this multiplied by this, you will get the expense. So 1316 man days is what we have calculated. Then in the second case, the newcomers, which are 6%, because out of 350, 6% are newcomers, they have only 10 days of entitlement. Out of that, they have taken 9 days. 1 day is the closing balance, and total man days become 21 man days per person. 21 man days in total. 1316 plus 21, you have 1337. Salary now revised to 16,500. So 16,500 into 1337, you have 2 crores 20 lakhs 60,500. Opening balance 65 lakhs. So whatever is the balance, the difference between these two, this will be provided. Now accounting entry, you can pass these two entries. This can be slightly complicated. You can pass a net entry for increasing the expense as well. So either pass a net entry 220 minus 65,000, basically this and this. You can pass a net entry, or you can say previous year leave encashed, previous year leave thing has been taken. So whatever we pay as salary in the current period, that includes previously brought forward accumulated leave also. So if I pay salary of, let us say 100, what I am saying is 65, for example, pertains to brought forward balance. Or if I am paying 1000, 65 pertains to brought forward balance. So that is why I have credited here. And current period employee benefit expenses 220, 500. Is it clear? Now, there could be sometimes profit sharing plans and bonus plans. Now, what are these? These are basically payments to employees, saying that if you make so much of profit, let us say we'll pay 5% of profit as bonus. Okay, these are called profit sharing plans. Now, here you have to make an estimate of what is the percentage of profit that you are likely to pay and how many employees are likely to be entitled for that. So, by considering that, you will provide for the expense, right? So when you provide, when you have the present obligation and you can make an estimate, these are same as Ind AS 37 criteria, only then you will create the liability, right? And based on that estimate, you will create the liability. And also you will see how many employees will be entitled to that plan, or what is the expected realization, or what is the expected payout from the profit sharing plan. Now, as far as short term benefits are concerned, you will provide for, or you will measure them on an undiscounted basis, because we are settling everything within a period of 12 months. So you will not discount the short term benefits. Then you do not need any actual valuation. Actual valuation or actuaries services are needed subsequently. Subsequently means for the long term plans. Whenever you have long term plans, you will need actuarial valuation or services. So you will measure the undiscounted amount of short-term employee benefit, and if there is something which is payable, there will be a liability. If something is prepaid, means you have paid more than the expense, it is an asset, and you will create it as an expense. So whatever is the balancing figure will becomes an expense, right? So that is about short-term employment benefit. Very simple. If a question comes in the examination, you must be able to score 8 out of 8 or 6 out of 6 or 10 out of 10. Are we good? Are we able to understand this? Okay, great. Now we move on to long-term benefits or post-employment benefits, that we will be understanding, where we have post-employment benefits. For post-employment benefit means you make those benefit payments after the employment or after the employment gets over for the employees. Right. Now, I gave you example initially of one provident fund and the other one is your, let us say, gratuity. Okay. Now, when we have provident fund and gratuity, there are two types of payment which happens for post-employment. Means basically you get the PF amount after you retire, you get gratuity amount after you retire or after you resign, either ways, right? Now, in case of provident fund, you have, let us say, 12% of salary. This 12% of salary is contributed to a fund. So, you have an employee, you have an employer, and you have a fund. The fund can be the employer's own fund, means they have created their own fund, or it can be the statutory fund. What employer does is, employer contributes, as I told you, 12% of salary to this fund. At the time of retirement, resignation, whatever is there, this fund has to pay the amount to the employee. So whatever is the accumulated balance, this fund will pay the amount to the employee. The employer is no longer responsible whether or not the amount is sufficient in the fund. So after, for example, after you make the payment to the provident fund, this 12% of salary, employer says, Tata bye bye. I do not have any further responsibility. Whatever is the amount to be paid, this fund is responsible. This fund is responsible to pay the employee. Okay. Now here, two things are there. One, what is the amount to be paid? This is defined. Second, there is no further liability. What is the amount to be paid is defined and there is no further liability. Okay. So, in this scenario, when the amount to be paid, the contribution of the employer is defined, and when there is no further liability, we say it is a defined contribution plan. It is a defined contribution plan. What is defined? The contribution is defined and there is no further liability. Now, the second category is, let us say there is an employer, there is an employee. The employer says to the employee, if you work for 5 years, I will pay you 15 days of salary. I am using 15 by 30, 15 by 26 as per the question, whatever is the thing. 15 days of salary. Okay, don't get into income tax mood. Okay, for every completed year of service. Okay. Now, the employer thought that I have to pay 15 days salary. He estimated the salary at 10,000 for 5 years. So 15 by 30 is 2, then 2 into 5,000. So we have to pay a total of 25,000. But what happened was, the salary got revised to 15,000. Employer said, or employer made an estimate that I will pay based on 15, but actually the salary came out to be 15,000. He said I'll pay based on 10, sorry, and the salary worked out to be 15. Now I have to pay more. Can the employer say that I will not pay the extra amount? Here we have defined a formula. The amount to be paid, the benefit to be paid is defined. Can the employer say I will not pay the extra amount because I thought only 10,000, so I will pay only 10,000? Can he say that? He cannot say that, right? So if he cannot say that, then whatever is the extra amount, instead of 25,000, if it is 37,500, the employer has to pay from its own pocket. No sir, the employer did not think, that does not matter. Employer did not create liability, that does not matter. Whatever is the shortfall from this kind of plan, employer will have to make the payment to the employees. So, when we talk about a post-employment benefit plan, we have a defined contribution plan and a defined benefit plan. A defined contribution plan is made, in that case, the contribution to be made by the employer is defined. Meaning to say, what is the amount of contribution, or what is the contribution that the employer will make. 12% will be made to PF, that is defined. Whereas in the defined benefit plan, the benefit to be paid to the employee, that is defined. For example, 7 days salary or 15 days salary, 15 days salary, this is defined. So the employer says, okay, 12% is defined. So after this 12%, the employer is not responsible. But here, because the amount to be paid is defined, the final benefit is defined, that means the employer will have to bear the risk, and any shortfall has to be made good by the employer. Here, no further risk is borne by the employer. So that is about defined contribution and defined benefit plan. Example as I gave you, here you can have pension. Okay, or here you can have pension, which is contribution. You can have a pension defined contribution like NPS. Here you can have pension formula based. Okay, so that is how it is accounted for. Any questions on this? Is this clear? Great. Did you get some more clarity about defined contribution and defined benefit? Now, when it comes to accounting of defined contribution and defined benefit, the best part is defined contribution is simple. Why? I know I have to pay 12% of salary. So, 12% of my salary every month, I will say this is my expense to PF payable. Every year, whatever I pay, I'll say expense to PF payable, right? I don't need to discount, and I don't need to make any estimates. I don't need to involve any actuary. It is very, very simple and straightforward. So, defined contribution plan is, in this case, the obligation is limited to the amount that it agrees to contribute to the fund. Actual risk and investment risk will fall on the employee. If tomorrow the fund does not generate sufficient return, employee will bear the headache, not the employer. Okay, and you will discount only if more than 12 months. So if you have to contribute after 12 months, very unlikely scenario, that is when you will discount. Otherwise you will not discount. And entry will be, as I told you, simple and straightforward. What is the amount payable, that you will directly recognize it as an expense. So let's have a look at a question. I don't know why this notability has to get updated only when I'm taking class. Let's have a look at this question. Acer Limited provides lump sum remuneration upon retirement to its employees. Remuneration is paid out of fund to which Acer Limited contributes 12% of annual gross salaries. Contributions are made twice a year, in November and in June after the financial year end. Total gross salary for year 1 amounted to 50 crores. Contribution made by Acer Limited in November year 0 was 2.8. Remuneration depends on the number of employee service and amount of cash in the fund at the retirement date. Acer Limited has no further obligation except for contribution. Now what does that mean? Acer Limited says, I will contribute, and whatever I have contributed, after that I don't have any further responsibility. So this is my DCP, defined contribution plan. This is my DCP, which is my defined contribution plan. In case of defined contribution plan, it is very simple. You have to identify how much should be paid. You have to identify how much should be paid. So, annual salary is 50 crores. Out of 50 crores, you have to contribute how much? 12%. So, 12% of 50 crores is 6 crores. Out of 6 crores, in November we paid 2.8 crores. So, this 3.2 crores is a liability, current liability, which is payable. So, my expense is 6, to cash or bank 2.8, to liability balance 3.2. That is how you do the accounting for it. Okay. Now, in case of defined benefit plan, the obligation is to provide agreed benefits. Benefits are defined, and once the benefit is defined, it is my responsibility to pay my employees. I cannot say I did not estimate. I cannot say I did not have money, or I don't have the money. It is my responsibility to make the payment to employees. Now, in that case, risk is on the entity. If there is a shortfall, I have to bear the risk. Now, you may have a doubt, sir. What is this investment risk and actual risk? See, investment risk is when I collect money or when I provide for money. For example, I have to pay gratuity. I know I have to pay gratuity. For making the payment of gratuity, what do? I start accumulating money and I start investing in various securities. Of course, there are rules how it is to be invested. I invest in multiple securities. Now, it may so happen that market may not give me expected return. Some portion can be invested in equity also. Or suddenly the interest rates in the market fall. If the interest rates in the market fall, again, I may not be able to get sufficient return. Or interest rate rises, my value of investment falls. It can be any scenario. So, the risk of investment in case of a defined benefit plan is on the employer. The employer will have to bear the risk. What is this actuarial risk? So, if I have, let us say, 10,000 employees, I cannot go and ask every employee, how long will you work, when will you resign, how many leaves will you take. All of that I cannot do. So, what I will do is, for these 10,000 employees, I will employ an expert called an actuary, who is someone who will be able to forecast expected number of employees who will leave in the next year, number of leaves that each employee will take, number of employees who will die, expected salary increase, what will be the interest rate, and all of that. All of that is given by actuary. So let us say actuary says 50% of your employees will continue or will be entitled to gratuity. If 50% of employee will be entitled to gratuity, that is what on the basis of that I have kept amount aside. Subsequently, what happened is 60% became entitled. Now I cannot say, I estimated 50%, I'll pay only 50%. Now if the number of count is 60%, I have to pay to 60%. So I expected that there will be only 50%, but I got, or actual outcome became 60%. So because of the estimations error, there is an actuarial risk. Both of these will be borne by the entity. So these are the differences you can go through. I have already discussed in detail. For defined contribution plan, simple compensation expense to liability or bank, and you will make these disclosures. Amount recognized as an expense and information about contributions to defined contribution plan for KMP as per Ind AS 24. Any questions? Okay, all clear. We will pause here, and tomorrow with a fresh mind, tomorrow or Monday I will let you know in the group, we will start defined benefit plans. Okay, thanks a lot for joining in. I hope you have understood the nuances of short-term absences and defined contribution plan, and detailed difference between the defined contribution and defined benefit plan. Thank you.